In this video, I'm going to review the performance of the Albert E Sharp model portfolios for May 2020. And this month, I'm going to take an in-depth look to see how we compare against some of our closest competitors. This will demonstrate 3 reasons why Albert E Sharp's investment process stands out from the crowd. Hi, my name's James Crocker. I'm a partner here at Albert E Sharp, and my main responsibility is in the management of the model portfolios that we run on behalf of financial advisors across the United Kingdom. Today I'm talking about the core risk-rated multi-asset portfolios that we run on the various platforms that include Standard Life, Transact, Novia Nucleus and many more. So pretty much across the board, May was another good month for equities, with UK mid-caps having a particularly strong run, up almost 8%, well ahead of the FTSE 100, up just 3%. Continental Europe fared well, approaching mid-single digits, while the US continued its rise, up over 4%, and the Nasdaq is now up by almost a third over the last 12 months. Asia was weak, with China, Hong Kong and India some of the markets in the red for the period, but Japan was the star performer across the region, rising 8.3% in local currency and 9.8% in sterling terms. Fixed income saw government bonds broadly unchanged, although inflation-linked issues were squeezed higher, along with higher yielding corporate debt. The oil price continued to recover alongside most other commodities. So how did our portfolios fare given this backdrop? Now, to remind you, the benchmarks that we use are constructed by asset risk consultants, otherwise known as ARC, who each month gather portfolio return data from the vast majority of UK discretionary fund managers and give us an average. So starting at the top, we see the ARC Equity Risk Index, and this is for the portfolios that will tend to have the high equity allocation, which could in theory be right up to 100%. So for the month to the 30th of May 2020, the average portfolio returned 2.9%. Importantly, all index numbers here are net of management fees. Our management fees are 0.6 per annum. That's 0.05% per month. Now, as we go down the risk spectrum, we see that the average steady growth portfolio returned 2.7%, balanced 2.3%, and cautious was up 1.7%. We also run a couple of additional low-risk portfolios that are measured against LIBOR, which at the moment is so low it's still at 0 to 1 decimal place. So overlaying our numbers in blue, you can see that we had a great month. Our all-equity Model 10 portfolio was up 7% after fees, with Model 7 and Model 8 not far behind. Again, our Model 6 is way ahead of the steady growth benchmark, with Model 4 and Model 5 thrashing the balanced average, with the same story in the cautious category too, although 1-2 remained flat after charges matching LIBOR. Now, I realise 1 month does not a summer make, as it were, and I'm very hesitant to draw conclusions based on such a short timescale. But I think we need to explain why we're ahead by such a large margin, particularly in the high risk categories. So starting with the ARC Equity Risk category, you have to appreciate that not all portfolios will have 98% in equities, as we do in our Model 10. So maybe a fairer like for like would be our Model 7, which has 80% in equities. But even here, we've delivered double the ARC index return, and I think there are 2 reasons. Firstly, it's home bias in the benchmark. Time and time again, we see portfolios with a disproportionately large weighting to the UK because we're based in the UK. I guess it's understandable, it feels comfortable, it's familiar, but it isn't the basis for making an investment decision. Quite why we would be so lucky to be at the epicenter generating the world's highest stock market returns, I really don't know, because it's not as if we have a track record of doing so. Here's the FTSE All-Share against the main regional equity markets over 1 year, going through to 5 and right out to 25 years. And quite clearly, as you can see, we've hardly been in pole position over the period. In fact, home bias increases risk because it reduces diversification, essentially having too many eggs in one basket. And if you had a small amount of exposure to the US in particular and had lots of trackers, well, it becomes quite clear how your performance is going to get hurt. And this brings us neatly on to the second reason why we think we're so far above the average. It's passive bias. It's all based on the notion that an index cannot be beaten over the long term, and so the optimal way of investing is to buy a tracker. Now, this is anathema to us because we think due to human behavioural predispositions and structural reasons, markets are not perfect and it is possible to consistently outperform. And Japan is a great example, and this is where we saw our strongest returns last month. The Nikkei 225 was up 8.4%, Lindsell Train Japan up 7.1%, and the Legg Mason Japan Fund up 14.3%. Now, okay, Lindsell Train lagged, but we'd never base a decision just using 1 month of data, and besides, it's still way ahead of the UK. And over 5 years, it pales into insignificance. Because if you'd have held both funds in equal measure, you'd have doubled your money. If you'd have held the index, you'd be up about 16%. If you'd been in the FTSE All Share, you would have made about 12%. Now, it would have been simply wrong to have had little or no exposure to Japan because you were worried about the demographics or Abenomics or tensions with China or deflation, let's say. The returns that we've delivered rams home the point that making macroeconomic forecasts for a country or predicting how the political climate might change over time is simply not going to get you very far. The quest is to find a fund manager with outstanding stock selection skills in the region, especially one who can deliver in the face of a challenging backdrop. And that mantra, I suppose, permeates our thinking throughout the portfolio. And in the final analysis, it is the reason why we're so far ahead, particularly recently, but also over the last 5 years for that matter. And one of the major contributing factors is our sizable exposure to the US. With dedicated exposure to technology and small caps, many of our clients have enjoyed some amazing returns over the last 5 years. Now, one final observation is that a lot of our peers seem to have had a very high level of cash since April, and that will definitely have acted as a drag. Going into the coronavirus crisis, we held more cash than usual because we sold down our property exposure. But we put this back to work in fixed income pretty sharpish in April, and this certainly goes some way to explaining the performance in the cautious portfolios and the lower risk portfolios and why they've done so well. Now, it's all very well looking at average numbers. Most advisors want to know how we compare directly to the big names in the DFM industry. So this month, I've spent a bit more time than usual looking at the competitors' performance, what is in their portfolios, trawling through the fact sheets and trying to form a view on their process. Now, admittedly, this isn't something I do routinely. There are only so many hours in the day. I think our time is best spent sticking to our knitting, keeping our own counsel. But it is very difficult for me to answer the question, what makes Albert E Sharp unique, if I don't know what it is we're being compared to? And every time I do this, I really remember what a horribly messy job it is. I've got every sympathy for those in the IFA world who are trying to do this. It's really an involved affair. You're forever finding yourself asking more questions the more you dig. Is performance net of fees? Does the portfolio contain a fund run by the manager? When is the equities? Where does property come into this? Where does infrastructure come in? What does the other category contain? What is the benchmark? Is that something you devised in-house that nobody else uses? What does the OCF actually include? Has the asset allocation changed a lot recently? Has the investment team changed a lot recently? To what degree is past performance a true reflection? Ultimately, there is often a real lack of transparency, and you really need to know what you're looking for and how to ask the right questions if you want to come to a comfortable conclusion. But the good news is, it is possible. But as I found, it's just very, very time consuming. And if you're a financial advisor and you'd like to have a look in more detail at the results that I came up with, by all means, get in touch. I'd be happy to share this with you. Really, what I found most difficult was quickly establishing true like-for-like comparisons when it comes to portfolio risk. The external agencies such as De facto, Dynamic Planner, eValue or Synaptics place ratings to achieve exactly this, but sometimes there are huge inconsistencies. And for example, if you look into a portfolio rated 7 out of 10, have a look at the exposure to equities and then have a look across the various DFMs. You'll see a huge difference in results and you'll see a huge difference in returns. So a badge with a number is not the answer, I'm afraid, and you will need to satisfy yourself that when looking at performance, you need to be sure that you are comparing apples with apples, and also sometimes it just simply isn't possible. So I've picked out what I see as our top 4 competitors using publicly available model portfolio performance numbers from their websites to May the 30th, 2020. Now, I'm going to do my best here to keep it simple. Bear with, there's no easy way of showing this. What we see here is the performance of an Albert E Sharp Model 3 portfolio, an AS3, and going left to right in the yellow boxes, we've got the performance numbers for 1 month, 3 months, up to 5 years. All management fees have been stripped out. I've then side by side put the model portfolios and comparable equity exposure from our competitors that I've called Firm 1, Firm 2, Firm 3 and Firm 4. Now here Firm 1 has a portfolio that they call defensive with 22% in equities, compares to 23% for us. Face value looks like a reasonable comparison, though admittedly I don't know how much equity exposure they would have had 5 years ago, say. But what we can see is that the difference in performance over 1 month was such that we were ahead by 1.4%, fractionally ahead over 3 months, and as you go across, winning by 0.6 over a year, but behind by 6.8% over 5 years. Firm 2's got higher equity exposure with 25.5%. They've got the edge and they beat us over 1 month. And as you can see, as you go towards the right, they beat us by 8.7 over 5 years. Firm 3 don't disclose 1, 3 and 6 month numbers, but over 1, 3 and 5 you can see we're ahead on all counts. But that said, our equity content may well have been higher in the past if the current split is anything to go by. Incidentally, Firm 4 don't run 1 month numbers, and we were ahead despite having lower equity exposure. So you might look at this and think, okay, you're not exactly selling it to me, especially when we look at the 5-year numbers. Please stick with me here, because as you will see, this picture is about to change very dramatically. There is an explanation for this, by the way, which was a zero direct allocation to UK government bonds and missing out on a very strong period in 2016. I touched on this in the previous video for April, which provides more detail. Please refer to that if you have the moment, if you have the time. Okay, there's a lot going on in the table, and putting it into a bar chart makes things a bit clearer. I think it's tempting to say that looking back, if there's a winner, it's probably Firm 2 and their cautious portfolio because of the 3 and the 5-year numbers. But if you're selecting a firm for your client's money, does that mean that number 2 is the portfolio to go for? Isn't the drawdown over the last 3 months a cause for concern, or the general volatility of returns over the last 6 months? That said, Firm 3 don't provide us with this data. Is that a help or a hindrance? Now, I would of course be inclined to point out that there is clearly lost ground being made up by the black line here, Albert E Sharp, who are ahead over the last 12 months. But what's behind this? Will it continue? There are lots of questions to ask. The numbers only go so far. But I suppose trying to reverse roles here, when selecting a DFM, a lot of the factors are going to be similar, if not exactly the same, in terms of fund selection that we go through. From our point of view, one of the critical factors is simply trying to understand exactly what it is you're buying into with a fund manager. What makes them different? Is there a clear, repeatable process? And if there is, if there's a distinct message, a philosophy for want of a better word, then that gives you something to go on. Not least because if things change, then it may provide you with a basis to get out. So we find that a nice test is if you can go away from a meeting and write down, say, 3 bullet points regarding how they invest their money. That's a great starting point. And if you can't, then that probably goes some way towards giving you the answer. At the end of this video, I'll spell out exactly what I would like to think are the 3 Albert E Sharp bullet points. So back to the numbers, because these are so important in providing validation to the investment process. It's an important yardstick as long as it's properly calibrated. And the Albert E Sharp Model 4 cohort highlights the importance of getting your measuring equipment right. Now in this instance, we can see that actually only Firm 2 and Firm 4 are worth making a comparison against, because the equity content for Firm 1 and Firm 3 is so much lower at 34% compared to 46%. So if it's apples for apples, AES certainly wins out on every count here, apart from 5 years where we're behind by just 1.9%. In Model 5, things start to straighten out a bit more, and this is probably the most telling of all, because although Firm 1 has a fraction less equity exposure, We have much less than firm 2, 3 or 4, and our performance is demonstrably better over every period. Now, it's fair to say that most of our portfolios fall into this AES5 category, although we also have a lot in AES6. We need to be a little bit careful here in that we have a higher equity weighting than firm 2, certainly, but the size of the outperformance more than offsets this. And against firm 3, it really is material over 3 and 5 years. As we go into model 7, the story continues. With less equity exposure than firm 1, 3 and 4, we are ahead significantly over every time period. Quite noticeably, firm 3 seems to be coming out of this analysis quite badly, you might have noticed. In model 8, this is even more stark, with a gap of 21.2% over 5 years. Don't forget, this is all before management fees are applied, of course. But whatever these are applied at, these are not going to be anywhere close to the opportunity cost to the client of being in the wrong model. Opportunity costs are very real, especially when the client hears Jim Bones' catchphrase from Bullseye all those years ago, "Look at what you could have won." Model 9 doesn't exist in this multi-asset framework, so jumping on to Model 10 here, I've completely missed out 1 and 2 because they're the highest risk comparable portfolios, stopped at 8. But suffice to say that once again, we have the top spot over all periods. The intriguing question here is how come firm 3 was such a long way behind in all of the others, but massively caught up in number 10? The one thing for sure is that all discretionary fund managers are not the same, certainly as judged by performance. The allegation that when it comes to model portfolios, they're all much of a muchness is simply not true. So what would I say are Albert E Sharp's 3 bullet points? Well, number 1, our aim is to maximise return for our clients. It is to be the number 1 position in the DFM Performance League table. Number 2, we can only achieve number 1 position by avoiding index trackers and finding a way to identify genuinely exceptional fund managers, and we've been successful in doing just that. Number 3, consistent outperformance does not necessarily involve taking on additional risk. It requires the ability to truly know what you're doing. And the performance numbers here speak for themselves. And I end on this thought, if you're using a DFM right now and we see another wave, I refer you to what happened to the Spanish flu in autumn 1918. Do you think the current strategy will protect you? If you think we're going to get over this and enjoy some kind of a recovery, will the existing way of playing things get you the very best return for your client? Well, put it this way, the Albert E Sharp portfolios are designed to give you the best of both worlds. For once, you can have your cake and eat it. So thanks for watching. If you found it useful, don't forget to subscribe and give us a thumbs up below. I appreciate that a lot of the charts referred to here don't lend themselves too well to video. So if you're a financial advisor and you would like to go through them in more detail, please do get in touch and we would be more than happy to arrange a video call. My details are here, but also Mark Atherton and Alistair Power will be able to answer any questions that you may have. Next month, we will be reflecting back at the tumultuous first half of 2020. If there are any questions, please let me know. And in the meantime, stay safe.